This is TechCrunch. LinkedIn's Chief Global Affairs and Legal Officer, Blake Lawit, confirmed in an interview at the Semaphore World Economy Summit this week that the company's data shows a decline in hiring of around 20% since 2022. But he pushed back at the idea that artificial intelligence was to blame. He said, "At LinkedIn, we have an economic graph which is over 1 billion members. We've got companies, jobs, skills. It's really an amazing real-time view of what's happening in the labor market. And we've looked because everyone wants to know the answer to this question. Is AI impacting jobs right now? We've looked, and honestly, we haven't seen it." Instead, he suggested that the decline in hiring was more closely tied to a rise in interest rates. Lawit continued, "We have not seen the sort of impacts that you would expect to see in areas that everyone is talking about AI, like industries, whether or not it's customer support or administrative or marketing, all these places that if we were seeing impacts from AI, well, that's where it would be. Yes, hiring's down, but not down more." He also noted that LinkedIn's data did not indicate that the decline in hiring of college-aged young adults getting their first jobs was down more either, when compared with people who were in the middle of or later in their careers. Still, he did not rule out that things could change. "It doesn't mean it's not going to happen in the future, but not yet," he said. On that point, however, Lawit had a warning of sorts. He noted that over the last several years, the skills that are needed to do the average job have changed 25%. With the rise of AI, LinkedIn expects that figure to be 70% by 2030. So even if you're not changing jobs, your job's changing on you, he said. Well, after selling its shoe brand and assets last month for $39 million, Allbirds is pivoting to AI. Of course, the company is also changing its name since the footwear brand Allbirds was part of the sale. Introducing NewBird AI, a fully integrated GPU as a service and AI native cloud solutions provider. That's according to the company announcement via its investor relations site on Wednesday. The rebranded AI company also announced a $50 million investment from an undisclosed institutional investor in the form of a convertible financing facility. It's objectively pretty funny that Allbirds is becoming an AI company, not because it's unusual for companies to pivot, but because of how extreme this pivot is. The maker of the shoes, once craved by the Silicon Valley tech set, is now going to be a provider of GPUs. It's somewhat absurd and risky, but you can see how the business came to this decision. After the asset and brand sale, Allbirds can keep the public company's shell. It's been traded on NASDAQ under the ticker symbol BIRD, and then reuse it to invest in the hot AI sector. This recalls the time in 2017 when the Long Island iced tea company pivoted to the blockchain, prompting the stock to jump some 275% after the rebranding. That pivot did not pan out, as the NASDAQ stock exchange delisted the stock the following year after Bitcoin fever died down. Allbirds turned NewBird is likely hoping for a different outcome. The company says that the financing and the asset sale are still subject to stockholder approval, with a meeting planned to take place on May 18th. If the sale goes through, stockholders will receive a dividend during the third quarter. The new owner of the Allbirds brand and assets, American Exchange Group, will continue to make products for Allbirds customers. Meanwhile, NewBird AI plans to use the new financing to acquire GPU assets, which it will offer to customers seeking AI compute capacity. Over time, the company hopes to grow its service offerings through partnerships and even strategic mergers and acquisitions if the opportunity arises. Since its launch in 2021, Gizmo, an AI-powered learning platform that transforms students' notes into interactive study materials, has attracted more than 13 million users across over 120 countries. That is a significant jump from the more than 300,000 users the platform had when TechCrunch last covered it back in 2023. And as user adoption increases, investor interest is following suit. The company recently secured $22 million in Series A funding. That funding will go toward expanding Gizmo's engineering and AI teams, as well as expanding its presence in the U.S. college market. The company, which had just 7 employees prior to the raise, plans to scale to around 30. The company's momentum comes at a time when student behavior is shifting. Academic performance in the U.S. has hit a historic low, according to the 2025 National Assessment of Educational Progress. Excessive screen time and reduced attention spans have been noted in previous studies as contributing factors. Plus, with many young learners drawn to platforms like TikTok and YouTube, the biggest challenge for edtech startups is how to sustain engagement. Gizmo is betting that gamifying learning may be the solution. Designed for teenagers and young adults, Gizmo believes that its appeal is the use of game mechanics to drive engagement. Features like leaderboards, streaks, limited daily lives for incorrect answers, and the ability to challenge friends are designed to keep users coming back. Other micro-learning platforms have also gained traction in recent years, such as Anki, Quizlet, and Nibble, alongside newer entrants such as and Knowit, which have all attempted to redirect screen time habits into productive learning. But for a young learning app like Gizmo to grow this much interest in just a few years is notable. For comparison, touts 1 million app downloads, and Knowit has more than 7 million users. The Series A round was led by Shine Capital, with participation from Ada Ventures, Seek Investments, GSV, and NFX, which previously led Gizmo's $3.5 million seed round. That's all for now. For more stories like these, go to TechCrunch.com.